Hello friends, and welcome back to the Houman Trades channel. Today we're diving deep into a book that has fundamentally reshaped how traders around the world approach the market. Mark Douglas's classic, Trading in the Zone. If you've ever felt the emotional roller coaster of trading, the frustration of missed opportunities, or the pain of unexpected losses, then this book and this video are for you. Mark Douglas wasn't just another voice in the trading world, he was a pioneer. He was one of the first to articulate with such clarity that the real edge in trading isn't found in complex indicators, secret strategies, or market predictions. No, the true edge, the consistent profitability, lies within your own mind. This book is a masterclass in trading psychology, designed to help us, as traders, break free from the shackles of emotional decision-making and cultivate a mindset rooted in probabilities, consistency, and unwavering confidence. Whether you're just starting your trading journey or you're a seasoned veteran looking to sharpen your mental game, the insights in this video can truly transform the way you approach the market. So, make sure to stick around until the very end. If you find this content valuable or it resonates with you, don't forget to hit that like button, share it with your fellow traders, and of course, subscribe to the Houman Trades channel. Your support helps us keep creating content like this. Also, if you want to go deeper, I've linked the full book and audiobook version down in the description. It's a great way to support the channel while leveling up your trading mindset. All right, let's jump in and unlock the real keys to consistent trading success. The core problem: why traders struggle. Let's start with a fundamental question. Why do so many traders struggle even with access to vast amounts of information, advanced charting tools, and sophisticated strategies? Mark Douglas tackles this head-on in the opening chapters of Trading in the Zone, particularly in what he calls the road to success, fundamental, technical, or mental analysis. In the beginning, most of us start our trading journey with fundamental analysis. It feels logical, doesn't it? We study companies, pore over earnings reports, analyze supply and demand, and keep a close eye on global news and economic indicators. The belief is simple. If you know enough about the fundamentals, you can predict where the market is headed. This approach is appealing because it offers a sense of control, almost like solving a complex puzzle. But as Mark Douglas points out, for many, this path quickly leads to frustration. Even with solid research, the market doesn't always move as expected. Prices often behave irrationally, driven by collective psychology rather than pure logic, and traders get caught off guard. When fundamental analysis disappoints, many traders shift their focus to technical analysis. This often feels like a breakthrough. Instead of focusing on why something is happening, technical analysis focuses on what is happening. We dive into price patterns, indicators, support and resistance levels. It's all about recognizing repetitive behavior in the market, believing that if we can master the charts, we can stay one step ahead. For a while, this shift can yield promising results. You might feel like you're finally in sync with the market, deciphering its hidden language. But then, problems inevitably begin to surface again. Even the best-looking setups fail sometimes. Trades that appear identical can have completely different outcomes. Your confidence starts to shake, and you begin to wonder, if I'm doing everything right, why am I still losing? This is precisely where Douglas introduces the real turning point: mental analysis. He argues, with compelling evidence, that the true key to consistent trading success lies not in the market itself, but within the mind of the trader. It's not what you know about economic reports or how well you can read a candlestick chart. It's about how you think, how you feel, and how you behave under pressure that truly makes the difference. The market, by its very nature, is unpredictable. It moves in probabilities, not certainties. Yet most traders operate with an overwhelming need to be right. This need, this psychological imperative, triggers a cascade of detrimental emotions: fear, hesitation, impulsiveness, and even revenge trading. In other words, emotions take over, and the carefully constructed method, whether fundamental or technical, gets lost in the chaos. Douglas makes it unequivocally clear: success in trading isn't just about having the right strategy, it's about having the right mindset. The consistent winners are the ones who think in probabilities, accept the randomness of individual outcomes, and most critically, manage their mental and emotional responses. They don't try to control the market, they focus on controlling themselves. This profound shift from external analysis to internal awareness is what truly separates the amateurs from the professionals. It's what allows a trader to remain calm amidst market turmoil, to stick to their plan, and to execute with unwavering confidence no matter what the market throws at them. The lure and the dangers of trading. Trading holds an undeniable, powerful allure for countless individuals. It represents the ultimate freedom, the freedom to work from anywhere, to be your own boss, and to seemingly have no limits on how much you can earn. The potential rewards appear endless, and for many, it feels like the perfect opportunity to escape the constraints of a traditional job or lifestyle. Mark Douglas meticulously explains that it is precisely this intoxicating sense of freedom that makes trading so attractive. Unlike most conventional careers, trading appears to have no boundaries. There's no one to answer to, no fixed schedule, and no cap on your earning potential. You can, theoretically, jump in with just a computer, an internet connection, and a trading account, and suddenly you're in the game. But, and this is a crucial point Douglas emphasizes, with this boundless freedom comes a hidden, insidious danger. Because there are no clear external rules, and because there's no structure enforced by someone else, the trader becomes fully and solely responsible, not just for the decisions they make, but for every single consequence that follows. Douglas draws our attention to a key, often overlooked issue. Trading gives the illusion of unlimited possibilities, but most people are simply not mentally prepared to handle that kind of profound, unfettered responsibility. The market, in its cold, impartial reality, doesn't care about your background, how hard you work, or how desperately you need to make money. It only responds to your actions. If you lack self-imposed structure, discipline, and clearly defined rules, the very thing that initially attracted you to trading, that sense of freedom, can become the very force that systematically destroys your chances of success. He explains that many traders enter the market with a fundamentally flawed mindset. They perceive trading as a path to easy money, believing that with the right system or a few lucky trades, they can get rich quickly. This creates dangerous, unrealistic expectations. And when trades inevitably start going wrong, as they always do, those inflated expectations quickly morph into crushing disappointment, paralyzing fear, or even reckless desperation. Douglas emphatically stresses that consistent success in trading is not about discovering some secret mystical method. It is instead profoundly about managing yourself, your emotions, your impulses, and your reactions to the outcomes of your trades. Without internal structure and unwavering discipline, even the most theoretically sound trading strategy will ultimately fail to save you. One of the biggest, most pervasive problems Douglas highlights is the widespread unwillingness among traders to create and adhere to rules. Traders often resist rules because they mistakenly believe rules will limit their freedom. But in reality, rules are the only thing that truly creates sustainable freedom in trading. Rules protect you from impulsive, emotional decisions. They help you act consistently and make objective choices, even when the market feels chaotic and overwhelming. Douglas is crystal clear on this point. Without rules, trading devolves into pure gambling. You might win occasionally, but you will never have control, and without control, there can be no consistency. He urges traders to fundamentally rethink what consistent trading truly demands. It's not just about market knowledge or technical skill, it's about internal structure, mental discipline, and above all, a deep respect for the process. Because the market, in its infinite wisdom, rewards those who are prepared, not merely those who are hopeful. Taking responsibility, the foundation of success. Chapter 3, Taking Responsibility, marks a pivotal turning point in trading in the zone. Here, Mark Douglas lays out one of the most profound and, for many, one of the hardest truths every trader needs to accept. You are 100% responsible for everything that happens in your trading. It might sound deceptively simple, but in practice, it is anything but easy. Most traders don't even realize how frequently they unconsciously shift responsibility, whether it's blaming the market's volatility, a bad tip from a friend, an unexpected news event, or even their broker's execution. But Douglas is unyielding on this point. Until you take full, unequivocal responsibility for every trade you take and every outcome you experience, you will never truly gain the mental edge needed for consistent success. He explains that trading is unique in its lack of inherent structure. Unlike a traditional job, there are no managers overseeing your work, no supervisors setting your schedule, and no predefined rules unless you actively create them yourself. You are the one and the only one clicking the mouse. You are the one deciding when to enter a trade, when to exit, how much capital to risk, and crucially, how to react when things inevitably don't go exactly your way. And here lies a core, often uncomfortable issue. Many people enter the world of trading, perhaps unconsciously, trying to avoid responsibility, not embrace it. They are drawn by the allure of the money, the excitement, the promise of a lavish lifestyle, but they desperately want to avoid the pain of being wrong. They want the market to behave precisely the way they expect it to, and when it doesn't, they feel betrayed, victimized, or even personally attacked. Douglas warns that this mindset is incredibly dangerous, because if you are constantly blaming something external to yourself, you are, in essence, giving up your power. You are implicitly saying, "I can't win unless the market helps me." And that deeply ingrained belief will keep you perpetually stuck, reacting emotionally to every price fluctuation, desperately avoiding losses, and constantly searching for someone or something else to explain why things went wrong. Instead, he urges you, with great conviction, to take back your power. He states, "If you've lost money, it's not because the market was against you. It's because of how you chose to engage with the market." This is a hard truth to swallow, but it is also incredibly liberating, because once you embrace full responsibility, you gain genuine control. You stop merely reacting to events and start consciously responding to them. You learn, you grow, you evolve. Douglas emphasizes that consistent trading isn't about being right all the time. In fact, it's quite the opposite. It's about making decisions with clarity, meticulously managing your risk, and accepting outcomes, both positive and negative, without the corrosive burden of guilt, fear, or blame. When you truly take responsibility, mistakes transform from emotional scars into invaluable lessons. Every losing trade becomes a data point, a piece of feedback that helps you refine your process, rather than a reason to beat yourself up or abandon your strategy. This shift in perspective is the bedrock upon which true trading mastery is built. Consistency, a state of mind. Mark Douglas introduces a truly revolutionary idea in Chapter 4, Consistency, a state of mind. For most traders, consistency is seen as an outcome, the result of a perfect strategy or a flawless method that wins most of the time. But Douglas flips this conventional wisdom on its head. He argues that consistency in trading isn't primarily about your strategy, it's fundamentally about your state of mind. He asserts that even the most robust and well-tested strategies will ultimately fail if your mindset isn't aligned with the unique demands of the market. Why is this so? Because trading isn't just about logic or a set of rigid rules. It's about how you think and feel when you're immersed in an environment of inherent uncertainty. The market is, by its very nature, unpredictable. That's a non-negotiable fact. Every single moment in the market is unique, a never-before-seen confluence of forces. So, when you enter a trade, you simply cannot know with absolute certainty what will happen next. And it is precisely this pervasive uncertainty that derails most traders. It stirs up a potent cocktail of fear, doubt, hope, and greed. All those powerful emotions that pull you away from your carefully constructed plan and lead to impulsive, regrettable decisions. Douglas explains that consistent winners have learned to think differently. They don't operate with the need to know what will happen next. Instead, they have meticulously trained their minds to be completely comfortable with uncertainty. They understand that any single trade is just one of many in a series, and while each trade might have a statistical edge, it comes with no guarantee of success. This is the profound shift to thinking in probabilities. Let's say your trading setup has a 60% win rate over a large sample size. That means, over time, you can expect to win roughly 6 out of every 10 trades. But here's the critical part. You don't know which 6 will win or when they will win. Therefore, you have to treat every single trade exactly the same, regardless of how it feels emotionally. You follow your plan, You manage your risk and you accept the outcome, whatever it may be. That, according to Douglas, is the hallmark of a consistent mindset. Douglas also highlights a really important, often overlooked point. Most traders already possess a system that, on paper, works. What they lack is the mental discipline to follow that system consistently without allowing their emotions to take over. They hesitate when they should act, they jump into trades too early, they second-guess themselves, and they deviate from their rules. This inconsistency in their behavior inevitably leads to inconsistent results. So, how do you fix this pervasive problem? It starts by shifting your focus from the outcome of individual trades to the execution of your process. You stop obsessing over whether a particular trade will win or lose, and instead, you concentrate entirely on doing the right thing every single time. This means placing the trade when your setup criteria are met, taking the loss immediately when your stop loss is hit, and taking profits when your target is reached, all without hesitation, without overthinking, and without emotional interference. Douglas acknowledges that this kind of unwavering discipline doesn't come naturally. It requires conscious effort, deliberate practice, and relentless self-awareness. But once you adopt this mindset, something truly powerful begins to happen. You start to feel a profound sense of calm and control. You stop chasing trades, you stop avoiding losses, and you become consistent, not just in your trading results, but in how you feel and how you act, trade after trade. Douglas leaves us with a simple yet profound truth. The real edge in trading is psychological. Consistency is not found in the market, it is meticulously built inside the trader. And once you realize that, you are no longer at the mercy of the market's whims, you become steady, focused, and fully in control of yourself. And that, my friends, is where true, lasting success begins. Perception and the market's perspective. In Chapter 5, The Dynamics of Perception, Mark Douglas delves deep into a critical aspect of trading psychology: how we perceive the market, and more importantly, how our personal experiences, deeply held beliefs, and powerful emotions profoundly shape that perception. He begins by highlighting a phenomenon that most traders never stop to consider. Two different traders can look at the exact same chart, observe the identical market conditions, and yet arrive at completely opposite conclusions. One might see a compelling buying opportunity, while the other might interpret the same data as a clear signal to sell. Why does this happen? Douglas explains that we don't perceive the market objectively. Instead, we filter it through a complex lens of our own making. These filters are constructed from everything we've experienced in the past: our wins, our losses, our fears, our hopes, our beliefs about success, and our self-image as traders. So, when new information appears on our screens, a price movement, a chart pattern, a news headline, it doesn't enter our minds neutrally. It gets immediately processed through these deeply ingrained emotional and psychological lenses. For instance, imagine you've recently suffered a significant loss from a breakout trade that ultimately failed. The next time you see a similar setup, you might find yourself hesitating, not because the trade itself isn't valid, but because your perception is distorted by the lingering fear of that past loss. You're no longer seeing what's truly in front of you. You're reacting to what happened before. This is precisely where trading becomes incredibly tricky. We like to believe we're making purely rational, logical decisions, but more often than not, we're emotionally interpreting the data. Douglas refers to this as the mental environment we trade in. And if this mental environment is cluttered with fear, doubt, unresolved losses, or a desperate need to be right, it will inevitably cloud our judgment and lead to suboptimal decisions. He introduces a profoundly important idea. Beliefs define perception. What we believe about the market, about ourselves as traders, and about what's truly possible creates our internal map of reality. If your belief system includes a deep-seated fear of losing or an overwhelming need to always be right, those beliefs will subtly, yet powerfully, distort how you interpret each and every trade. And once your perception is skewed, your decisions become inconsistent, leading to erratic results. Douglas offers a powerful analogy. It's like looking at the market through tinted glasses. If the lenses are colored by fear, anger, or overconfidence, everything you see in the market will be affected. You'll overreact to normal price fluctuations, you'll miss genuine opportunities, You'll exit winning trades too early or hold on to losing trades for far too long. Not because you're trading system is flawed, but because your perception is emotionally biased. So, what's the solution? Douglas asserts that you need to train your mind to observe the market without judgment. This means consciously separating the present moment from past experiences. Each market moment is unique. Just because something happened before doesn't mean it will happen again in the same way. If you're stuck in the past, dwelling on fear or regret, you'll inevitably miss what's actually unfolding right now. He encourages traders to develop profound self-awareness, to recognize their emotional triggers, to understand their personal biases, and to acknowledge how these internal factors influence their trading. Because once you achieve that level of self-understanding, you begin to see the market more clearly, not through the distorting filters of your past wounds or your future hopes, but as it truly is. This leads directly into Chapter 6, The Market's Perspective, where Douglas gives us another powerful shift in thinking. He encourages traders to stop viewing the market solely from their own limited individual perspective and instead try to understand the market from its point of view. He starts by reminding us of something crucial. The market doesn't care about us. It's not personal. It doesn't know who we are, how much money we need to make, or how many losses we've endured. The market is neutral. It is simply a collective reflection of all its participants, millions of traders around the world expressing their beliefs, hopes, fears, and strategies through the acts of buying and selling. So, if the market is just a collective output of human behavior, what does that mean for us? It means we have to let go of the deeply ingrained yet utterly false idea that the market is somehow against us or unfair. Many traders fall into this trap. They blame the market when trades don't go their way, feeling as though they were tricked or that some external force was out to get them. But Douglas makes it abundantly clear. That's just ego and emotion talking. The truth is, the market doesn't do anything to you. It simply is, a continuous stream of constantly changing information. He then explains that the key to becoming a consistently successful trader is to align your thinking with the market's true nature. This means accepting that the market is always right, realizing that price movement is not personal, and understanding that every single moment is a unique event. If you approach the market believing it should behave a certain way because of your analysis, you're setting yourself up for inevitable disappointment. The market doesn't owe you anything. It doesn't follow your rules. It follows the collective behavior of all participants. By adopting the market's perspective, you free yourself from the burden of expectation and open yourself to truly understanding and adapting to its flow. The nature of trading. Probabilities, not certainties. One of the most liberating concepts Mark Douglas introduces is the true nature of trading itself. He constantly reiterates that the market operates on probabilities, not certainties. This might seem obvious, but it's a truth that most traders intellectually acknowledge but fail to integrate into their operational mindset. The human mind is wired to seek certainty, to predict, to control. We want to know what's going to happen next, and when we can't, we often resort to fear, anxiety, or impulsive actions. Douglas challenges this fundamental human tendency. He argues that trying to predict the market with 100% accuracy is a futile exercise, a mental trap that leads to immense frustration and financial losses. The market is a dynamic, ever-changing entity, influenced by millions of participants, each with their own beliefs, intentions, and information. To believe that any single individual can consistently outpredict this collective consciousness is, frankly, arrogant and unrealistic. Instead, he urges us to embrace the inherent uncertainty. This doesn't mean trading blindly. It means understanding that every single trade, no matter how perfect the setup, has a probabilistic outcome. It can win or it can lose. This acceptance of uncertainty is crucial because it directly impacts our emotional state. When we expect certainty and encounter uncertainty, our minds generate fear. This fear then leads to hesitation, premature exits, or holding on to losing trades too long, all of which are detrimental to consistent profitability. Douglas's solution is to shift our focus from predicting individual outcomes to understanding and managing probabilities over a series of trades. He likens it to a casino. A casino doesn't know the outcome of any single roulette spin or blackjack hand, but they know with statistical certainty that over thousands and millions of plays, the odds are in their favor. They don't get emotional about individual losses. They simply continue to execute their edge, knowing that consistency will emerge from the aggregate. Similarly, as traders, our goal isn't to be right on every trade. Our goal is to consistently execute our trading edge, knowing that over a sufficient sample size, our edge will play out and generate positive results. This requires a profound shift in perspective, from a focus on individual trades to a focus on the series of trades. Each trade is just one more opportunity for our edge to manifest. It's not a personal statement about our intelligence or worth. It's simply a probabilistic event. When we truly internalize this, the emotional pressure to be right on every single trade dissipates, allowing us to approach the market with a calm, objective, and disciplined mindset. So, how do we practically apply this understanding of probabilities to our trading? This is where Mark Douglas provides a clear, actionable framework for developing a probabilistic mindset. It's not enough to simply say, "I accept that trading is uncertain." You have to actively train your mind to think in probabilities, to see the market not as a series of individual high-stakes events, but as a continuous flow of opportunities, each with a statistical edge. First, Douglas emphasizes the importance of having a clearly defined trading edge. An edge is simply a set of market conditions that, when present, give you a higher probability of one thing happening over another. This could be a specific chart pattern, a combination of indicators, or a fundamental setup. The key is that your edge must be objective, repeatable, and have a positive expectancy over a large number of trades. Without a defined edge, you're not trading, you're gambling. Once you have your edge, the next step is to test it. This is where many traders fall short. They find a strategy, have a few winning trades, and then immediately start trading with real money. Douglas advocates for a more methodical approach. You need to backtest and forward test your strategy to gather a statistically significant sample size of trades. This will give you a clear understanding of your edge's performance characteristics, its win rate, its average win-to-loss ratio, and its maximum drawdown. This data is not just for validating your strategy, it's for building a deep, unwavering belief in your edge. With this belief in hand, you can then approach each trade as just one more instance of your edge playing out. You're no longer emotionally attached to the outcome of any single trade because you know that your profitability comes from the consistent application of your edge over time. This is the essence of thinking in probabilities. You're not trying to predict the outcome of the next trade. You're simply executing your edge, knowing that the probabilities are in your favor. Douglas also introduces the concept of the 5 fundamental truths about trading, which are essential for cultivating a probabilistic mindset. 1. Anything can happen. No matter how perfect your setup, there's always a chance it could fail. This isn't a negative statement, it's a realistic one that prepares you for any outcome. 2. You don't need to know what's going to happen next to make money. This is a direct challenge to our innate desire for certainty. Your edge gives you a higher probability of success, and that's all you need. 3. There is a random distribution between wins and losses for any given set of variables that define an edge. This is a crucial point. Even with a 60% win rate, you could have a string of 5, 6, or even more losing trades. Understanding this randomness helps you stay disciplined during losing streaks. 4. An edge is nothing more than an indication of a higher probability of one thing happening over another. It's not a guarantee. It's a statistical advantage, and that's all. 5. Every moment in the market is unique. This reinforces the idea that you can't rely on past outcomes to predict future ones. You have to approach each trade with a fresh, unbiased perspective. By consistently reminding yourself of these 5 fundamental truths, you can begin to rewire your brain to think in probabilities. You'll find that your fear of losing diminishes, your discipline improves, and your trading becomes more consistent and less stressful. You'll be trading in the zone, where you're not fighting the market, but flowing with it. Eliminating emotional risk. One of the most significant hurdles for any trader is the pervasive influence of emotional risk. Mark Douglas dedicates considerable attention to this, explaining how our natural human tendencies, our desire for pleasure and avoidance of pain, can sabotage our trading efforts. When money is on the line, our emotions become amplified, leading to impulsive decisions that deviate from our well-thought-out plans. Douglas argues that to achieve consistent profitability, we must learn to neutralize, or at least significantly reduce, the impact of these emotions. The core of eliminating emotional risk lies in understanding and accepting the 5 fundamental truths of trading, which we discussed earlier. When you truly internalize that anything can happen, that you don't need to know what's going to happen next, that there's a random distribution of wins and losses, that an edge is just a probability, and that every moment is unique, you begin to detach your emotional state from the outcome of any single trade. This detachment is crucial. If you view each trade as a make-or-break event, the emotional pressure will be immense, leading to fear of loss or premature profit-taking. Douglas emphasizes that the market is a neutral environment. It doesn't care about your hopes, fears, or financial needs. It simply presents opportunities. Our emotional responses are entirely self-generated, stemming from our expectations and beliefs about what should happen. When our expectations clash with market reality, we experience emotional pain. To eliminate this pain, we must align our expectations with the probabilistic nature of the market. This means accepting that losses are an inherent part of trading, just like operating expenses are part of any business. They are not personal failures. They are simply the cost of doing business. To practically eliminate emotional risk, Douglas suggests several techniques. Firstly, strict adherence to a well-defined trading plan is paramount. This plan should include clear entry and exit rules, position sizing, and risk management parameters. By following your plan without deviation, you remove the need for real-time emotional decision-making. The decisions are made in advance, when you are in a calm, rational state. Secondly, he advocates for the concept of thinking in terms of a series of trades. Instead of focusing on the outcome of the current trade, focus on how it fits into a larger series. This helps to dilute the emotional impact of any single loss or win. Furthermore, Douglas stresses the importance of self-discipline and self-awareness. You must be able to identify when your emotions are beginning to influence your decisions. Are you feeling anxious? Are you getting greedy? Are you trying to get revenge on the market after a loss? Recognizing these emotional states is the first step towards neutralizing them. He suggests practicing mindfulness and observing your thoughts and feelings without judgment. Over time, this practice helps to create a mental distance between your emotional reactions and your trading actions. Finally, proper risk management is a powerful tool for eliminating emotional risk. By only risking a small, predetermined percentage of your capital on any single trade, you ensure that no single loss can significantly impact your overall equity or emotional well-being. When the potential loss is small and manageable, the fear associated with it diminishes significantly. Douglas argues that consistent winners have mastered the art of managing risk, not just financially but psychologically. They understand that protecting their mental capital is just as important as protecting their financial capital. By systematically working to eliminate emotional risk, traders can achieve a state of mental freedom where they can execute their edge flawlessly without the interference of fear or greed. This is a crucial step towards achieving the consistent profitability that every trader desires. Building a belief system for consistent success. At the heart of Mark Douglas's teachings in Trading in the Zone is the profound idea that consistent success in trading is not merely about mastering strategies or indicators, but about cultivating a specific set of beliefs that align with the true nature of the market. He argues that our beliefs shape our perceptions, and our perceptions in turn dictate our actions and ultimately our results. If our underlying beliefs about trading are flawed or contradictory, we will inevitably struggle, regardless of our intellectual understanding. Douglas identifies several key beliefs that consistent, successful traders hold. These are not just intellectual concepts, they are deeply internalized convictions that guide their every interaction with the market. The first and perhaps most crucial belief is that anything can happen. This might sound counterintuitive, as we naturally seek certainty. However, embracing this truth liberates us from the need to predict or control the uncontrollable. It means accepting that even the most perfect-looking setup can fail, and the most unlikely scenario can unfold. When you truly believe that anything can happen, you are mentally prepared for any outcome, which significantly reduces the emotional impact of unexpected events. The second core belief is that you don't need to know what's going to happen next to make money. This directly challenges the common misconception that successful trading requires clairvoyance. Instead, it emphasizes that your edge, your statistical advantage, is all you need. You don't need to predict the future. You just need to consistently execute your plan when your edge presents itself, trusting that over a series of trades, the probabilities will play out in your favor. This belief shifts your focus from prediction to execution, from anxiety to disciplined action. Thirdly, Douglas stresses that there is a random distribution between wins and losses for any given set of variables that define an edge. This is a powerful concept for managing expectations and emotional resilience. Even with a high probability edge, you will experience losing streaks. If you expect a perfectly alternating pattern of wins and losses, you will be constantly frustrated and tempted to abandon your strategy during drawdowns. Believing in the random distribution of outcomes allows you to remain calm and committed to your process, knowing that losing streaks are a natural statistical phenomenon, not a sign that your edge has disappeared or that you are doing something wrong. Fourth, an edge is simply an indication of a higher probability of one thing happening over another. It is not a guarantee. This belief reinforces the probabilistic nature of trading and helps to manage the emotional highs and lows associated with individual trade outcomes. When you understand that your edge is a statistical advantage, you don't get overly excited by a big win or overly discouraged by a loss. Both are simply data points in a larger series, contributing to the overall statistical outcome. Finally, Douglas asserts that every moment in the market is unique. While patterns may repeat, the underlying conditions and the collective psychology are constantly evolving. This belief prevents traders from becoming rigid or complacent. It encourages adaptability and a fresh, open mindset for each new trading opportunity. It means letting go of past successes or failures and approaching the present moment with a clear, unbiased perspective. Building this belief system requires conscious effort and consistent practice. It involves identifying and challenging your existing limiting beliefs about trading and actively replacing them with these empowering truths. Douglas suggests exercises like mental rehearsal, where you visualize yourself flawlessly executing your trading plan, accepting outcomes without emotional interference, and consistently applying these beliefs. Over time, as these beliefs become deeply ingrained, they transform your mental environment, allowing you to perceive the market more objectively, make decisions with greater clarity, and ultimately achieve the consistent success you desire. Conclusion. We've journeyed through the profound insights of Mark Douglas's Trading in the Zone, exploring how the true path to consistent profitability lies not in mastering complex market analysis, but in mastering ourselves. We've seen how the common pitfalls of trading, the frustration, the emotional roller coasters, the inconsistent results, stem not from a lack of market knowledge, but from a fundamental misunderstanding of the market's probabilistic nature and our own psychological vulnerabilities. From the outset, Douglas challenged our conventional notions of success, revealing that the real edge is mental, not technical or fundamental. He exposed the seductive allure and hidden dangers of trading, emphasizing that true freedom in this profession comes only through self-imposed structure and unwavering discipline. We learned the critical importance of taking absolute responsibility for every outcome, transforming mistakes from painful failures into invaluable lessons. And perhaps most importantly, we discovered that consistency is not an external market phenomenon, but an internal state of mind, cultivated by embracing uncertainty and thinking in probabilities. We delved into the dynamics of perception, understanding how our personal beliefs and past experiences can distort our view of the market, and how crucial it is to adopt the market's neutral perspective. We explored the liberating truth that trading is about probabilities, not certainties, and how internalizing this allows us to eliminate emotional risk and approach each trade with calm objectivity. Finally, we outlined the 5 fundamental truths that form the bedrock of a belief system essential for consistent success, enabling us to trade without fear, manage our expectations, and remain disciplined through both winning and losing streaks. So, what does it mean to truly trade in the zone? It means operating from a place of unwavering confidence, where you trust your edge, accept the inherent risks, and execute your plan flawlessly, regardless of the outcome of any single trade. It means understanding that losses are simply the cost of doing business, and that profitability emerges from the consistent application of your edge over a series of trades. It means detaching your self-worth from your trading performance and embracing the market as a neutral environment of endless opportunities. This journey of psychological transformation is not easy. It requires conscious effort, relentless self-awareness, and a willingness to confront and reprogram deeply ingrained beliefs. But the rewards are immense, not just financial prosperity, but a profound sense of inner peace, control, and freedom that extends far beyond the trading screen. As we conclude, I encourage all of you watching on Houman Trades to revisit these principles regularly. Don't just listen, internalize. Don't just understand, apply. Start by focusing on one principle at a time. Practice self-observation. Journal your trades, not just the technical details, but your thoughts and feelings before, during, and after. Build your belief in your edge through rigorous backtesting and consistent execution. And remember, the market doesn't create your experience, your mindset does. Thank you for joining me on this deep dive into trading in the zone. If this video has helped you gain a new perspective, please give it a thumbs up, share it with anyone who might benefit, and subscribe to the channel for more insights into mastering the markets. Until next time, trade wisely, trade consistently, and most importantly, trade in the zone.